This is the Silicon Valley real estate market update for the week ending December the 5th, presented Saturday morning, December the 6th at 9 a.m. You're welcome to join us live. Here are the key chapters we're going over in the associated graphics. Let's get into the first data slide. What we're looking at here is the turnover rate. The turnover rate is how long does it take to sell the existing inventory one time at the existing rate of sales. You can see that we're right now about 114%. 14% longer than normal, so slightly slower than the normal marketplace, but still Silicon Valley is normally superheated, so 14% slower than normal is still a fast-paced marketplace. The next slide was going to be the accepted offers, which is the orange line down here, and you can see it's about 78%. You have to pay attention because the last week is a fainter line. So we're about 78% of the transactions that we normally have. That means we're missing about 22%, almost a quarter, a little over a fifth of the normal market. You can see after the pandemic, we were down here at 30%, but we've only recovered to somewhere around 80%, and we've been at that now for almost 2 years. And the third metric is the inventory. This is just how much inventory is currently available. You can see that we're a little bit on the low side at about 97% of the inventory you'd expect based on the previous 10 years. Here is a summary of key metrics and then just a couple other points of interest. The first one is the turnover rate. To me, the turnover rate is the most important. It's the supply-demand balance, the seller-buyer balance. You can have a lot of sellers and a lot of buyers and you still have a hot marketplace, or you can have very few sellers and very few buyers and still have a hot marketplace. It's the ratio that's the most important thing. The gray line is where the median is for the past 10 years. The blue is always favoring the buyer, so that'd be the slowest marketplace, and red is a red hot seller's marketplace, which would be the fastest marketplace. The middle line coming down the center here, I'm a little bit off on the price reduction, but coming on down essentially in the middle is the current week. We go back one quarter so you can see what the market's been doing. And as far as the turnover rate, it's been basically following the normal pattern, basically following that gray line. The actual raw numbers for the current week are over here. So it's currently taking 39 days to sell out your inventory. 13 weeks in the past, it was taking 47 days. That was 17% slower. Now you're only at 13% slower. Typical's 35 days. The longest you'd expect is 47 days. And the fastest you'd expect for this time of the year is 21 days. Real estate is very cyclical, especially in Silicon Valley, more so than the other surrounding communities that we cover in the Northern Greater Bay Area at the end of this presentation. The next thing on there is time to sell. That's the marketing time. That's what sellers experience. Now, one of the big key differences between turnover rate and time to sell is time to sell only counts the sellers that are successful, because you look at how long it took for that offer to come in. And if the offer never comes in, it never gets into that data set. And so therefore, the long sellers that are just testing the market that never sell aren't impacting time to sell, but are impacting the turnover rate because they are an active listing. So that's one of the reasons why time to sell is normally faster. And in this particular case, we're a little bit longer, but that's one of the major distinctions. But you can see here, we're 23% longer than we normally are. But a quarter ago, we were 42% longer. So that's a fairly significant improvement compared to normal. And you can see the improvement happened basically 8 weeks ago. 8 weeks ago, you were right up here on the blue line. And now you've come down starting in week number 6 and 5 and 4 weeks ago. You're basically right on the gray line. And again, the typical and the shortest is over there if you're interested. Then we go on to price reductions. This is a measure of sellers' expectations versus the market reality. If the market's climbing, or it has been climbing, as long as it hasn't turned over yet, sellers tend to look in the rearview mirror, because that's what the real estate industry is trained to do, is look at comps. So if the market's improving, sellers are always have lower expectations than the market reality. If the market's peaked and is coming back down, then when you look in the rearview mirror, your expectations are higher and you have more price reductions. That's sort of the concept. You know, most of the people are doing their homework pretty accurately. Buyers are out there looking in a hot marketplace. If you're too low, it gets bid up. So sellers really don't have to do price reductions. In fact, in Silicon Valley, we sell something like 60% of the homes basically the first weekend on the marketplace. So you don't even have time to do a price reduction. That's why the average price reductions up here at 1.6%, just over 1.5%, is such a small number. The sellers that are actually taking price reductions are a big number, but that 1.6% was 180% bigger price reductions than you would expect. Right now, we're essentially at 1.5%, which is a 30% greater price reduction than you'd expect. So you'd expect somewhere around, it probably works out to about 115% or 1.15% of a price reduction on average. But again, remember, 80% of the sellers are doing zero price reductions. So those that are doing the price reductions are taking significant price reductions. Flipping over and looking at the buyer overbidding, this is a measure of how competitive the buyers feel the marketplace is. The buyers are not going to offer the seller more than the seller's asking if the buyer is not concerned about losing the property to another potential buyer. A quarter ago, we were overbidding at 3.33% above the seller's ask price. Normal is 5.8. So we were actually overbidding less than normal, which is why the purple line's down almost on, or actually on the blue line. It's below the gray line. Then we came up and we were performing normal. We continue to perform normal, and we're slightly above, if you notice. You're a little bit on the red side of that gray line, and you can see the current overbidding is 4.9%. The typical overbidding for this time of the year is 4.5%. You can see right here on overbidding, you went from 5.8 to 4.5. The market's typically cooling off at this time of the year. The buyers are feeling less competition. People are starting to get into the holiday spirits and have other things. Real estate is an optional event. Anytime anything comes up, that takes priority typically over real estate. In fact, this particular year with the Super Bowl in Santa Clara being the host city is going to have a bigger impact than if it was somewhere else. And right now it looks like the 49ers will at least go into the playoffs. That's extra activity for some percentage of the marketplace. So expect the real estate market to be slower taking off in 2026 as long as the 49ers are in the run for the Super Bowl and even to the Super Bowl, simply because it's local here. And, some people are going to be distracted because they're going to have more workload for that kind of event. And some people will be attending. And the next thing is offers accepted. And that's looking over the past 5 weeks. We're at 81% back here. We're now at 79%. So really no change in the percentage compared to normal. But look at the magnitude. We've lost 25%, but that's what you typically do. At this time of the year, the market's really cooling off. You were selling 2,000 offers back here just 13 weeks ago. Now that's down to 1,500 offers. Inventory is also crashing down. You can see we've gone from 104% to 97%. So again, not much of a change and a percentage of normal, but you've gone from 2,700 listings to 1,700. That's almost a third of the inventory disappearing in just 13 weeks. But it's nothing to be alarmed about because that's exactly what normally happens. That's why I put the gray line up here, is so you know what to be expecting. And the last one is simply the number of transactions that are closed. That's because that's what the industry runs on. It would be a lagging indicator. And you can see that it's at 80.5% of where it normally is. Here now is the summary of the micro market data that we'll be going over next. It's color coded. You have Santa Clara County at the top, San Mateo in the middle, and Alameda County at the bottom. You have your key metrics. The yellow highlight are the leading indicators. The orange are lagging indicators. Green are really not indicators. They're just points of interest. These are a percentage of normal. That's what the difference is. So this is comparing what the market's doing. So here the raw count gives you the market. If the time turnover rate here is a slow number, that's going to be a fast marketplace. Here, a number at 100% is normal. A high number is a slower than normal marketplace. A low number, 77 and 60, is a faster than normal marketplace. So it doesn't tell you how the market is performing specifically this year, but it tells you how it's comparing to the past 10 years. The offers are less of significant because you really need the ratio between the two, which is the turnover rate. Then appreciation and sold price is just there for points of interest. And on sold price, instead of following the median only, which is the middle number, I follow the cheapest 10 percentile on the left and the most expensive 90 percentile on the right. And I'm clearly seeing something that doesn't make sense. What I'm picking up right here is where the red cursor is on the right-hand side of the screen. That's for East San Jose, saying the cheapest home is 2.6 million, the most expensive is 5.1 million, and the most expensive is 19 million. That clearly has to be for some other geographical area. I do not know what happened on the price. I'm not seeing any other data that skips out as being weird, but my price information is clearly wrong. And Silicon Valley, the cheapest 10 percentile is not 800,000. So something went wrong with my pricing information. So ignore this information, and I apologize for that. Here's some actual more details for those that are following on their own or someone that has more questions. So here's the first micro market data. This is the turnover rate. This is how quickly you turn over the marketplace one time. You can see the Livermore, Pleasanton area is very slow. The rest of Silicon Valley is actually fairly fast. Look at these time frames. 28 days, 26 days, 27. The slower areas are 44, and then down in South County, it's 69 days. Atherton is 69 days. That's a fairly reasonable turnover rate. This is the turnover rate versus typical. So where is it faster than slower than normal? Foster City is indicating it's very slow. It's 4 times. And Foster City data is behaving weird, but it's also a very small metric. I think it was last week I looked at it, and I think it was only 9 properties on there. And anytime you're talking about a data set of only 9 properties in real estate, that's very unstable. When I started doing this back in 97, I tried to have 200 properties in each one of my micro market areas. We don't have the volume any longer to support that. Foster City is just too small. I probably should just delete it. But this is your turnover compared to typical. So you can see the market on the affordable areas is actually slower now than it typically is for this time of the year. The peninsula is starting to recover. It was doing poorly after the pandemic when we had shelter in place and remote working was more prevalent. Here's the time to sell for the typical seller, so you can start seeing where it's taking long to sell. And it's interesting to note that up here in Pleasanton and Livermore, where the turnover rate was really high, but the time to sell is actually still reasonable. It's only 43 days. What's happening is a lot of sellers in those communities are coming on the market for long periods of time without selling. So they do impact that turnover time, but they do not impact the time for the typical seller to sell because they simply don't sell. I can't put infinity in a time frame. It's too much work to take the when they go off the market and add that in somehow, count that as an accepted offer. What you would do is if you wanted to include the unsuccessful sellers, you'd look at the time on the market that haven't sold, and that would include everybody. But that's not the metric that I have elected to choose. And as long as you're consistent in your metric and you follow your same metric, statistics is useful. That's the beauty of statistics. You compare it to the same patterns. Time to sell for the 75 percentile sellers. So this is for 3 out of 4 sellers to sell. You can see this is versus 10-year normal. You can see that some areas are a little bit hotter than normal on time to sell. Some areas are a little bit cool because this looks like it is a shade of blue, which is sort of interesting. So the west side of the valley is actually slightly slower at 113% and 140% of the normal time. So 40% longer than normal. Price reductions. This is the magnitude of the different price reductions. This is the average, so they're small numbers, but you can see there's some areas that have higher numbers, like 3% in Morgan Hills, Saratoga, Los Gatos at 3.7%, Los Altos at 1.5%. I'm surprised to see that. Foster City's a 2% price increase, so probably had one of the 10 sellers, or how many ever sellers there are this week, raise their price by 20%. Overall, Silicon Valley is minus 1.5%, Santa Clara minus 1.3%, San Mateo minus 1.5%, and Alameda minus 1.4%. So price reductions are happening. This is the compared to normal. Where are we compared to normal? Essentially 101%. You can't get closer to 100% than that across the board. But even with being so close on on the large scale, you come down in Morgan Hills, 94% of normal. And then on the high side, you have Cupertino at 103. So there's still a 10% swing within each county. You got a 91% down in San Mateo County, and a high, you got 107%. And in Alameda County, you're a lot closer together. The lowest number I'm seeing is 95%, and the highest number I'm seeing is 99.9. So you even have a 5% swing total in the negative direction for Alameda County. Here's the price reduction frequency. So here you can see that only 22% of the sellers in Silicon Valley are doing price reductions, 21.5% in Santa Clara, 23% in San Mateo, and 22% in Alameda County. And again, you can start seeing the geographical hotspots and where the different sell areas are having the biggest price reductions or the least price reductions. This is the frequency of those price reductions compared to the 10-year normal. So 104%, so 4% more than normal, 9% more than normal in Santa Clara County, 2% more in San Mateo, and 6% more in Alameda County. This is the magnitude of overbidding. This is how much buyers are going in over the seller's ask price, and my yellow highlights are not aligned because my graph's not aligned, so I apologize I didn't catch that. But again, you can see it's mostly red. The one area that's blue is the San Mateo County coast and Pleasanton. Everybody else is either white in color or red, which means buyers are overbidding currently. Well, 5 weeks ago, they were overbidding more recently. And the reason I said 5 weeks is because you have to let escrows close to know what the sale price is. Here's the overbid compared to normal. You can't get closer to 100% than that. The highest number I'm seeing is 101%, two areas, Santa Clara and San Mateo at 101 and Alameda at 100. And even look at the price range, the low's 98, the top's 102. So buyers are feeling the absolute normal. So basically, I think that's the takeaway is based on the number of times I've said everything's normal is we got a normal marketplace compared to the past 10 years. Frequency of overbidding, this is just the raw count, 58, 59% for all Silicon Valley. San Mateo is the highest at 61. Alameda County is the least at 57.5%. And Santa Clara County is in between at 58.5% of the sellers are getting overbids from the buyers. Here's the frequency compared to normal. So even though more than half the sellers are getting overbid, you can clearly see for the most part, you have a lot of blue. So there's less overbidding, less frequent, fewer number of transactions are having overbid than normal. And you can see that Pleasanton is pretty blue. And what's the number on in Pleasanton? 66%. So it's a third fewer sellers are getting overbid than normally do for this time of the year. So there's still overbidding happening. It's just less than normal. Here's the appreciation for since the last 9 months of 2015. You can see the more affordable areas with a little bit longer commutes, but still reasonable commutes are doing the best overall on appreciation for the last 10 years. Some of the outlying areas are not doing so well, and the close-in areas in San Mateo County aren't doing as well either. I believe some of the reasons why the outlying areas aren't doing so well is they did really well right after the pandemic shelter in place and remote working was widespread. And then when people realized the commute, they started pulling back again. There's been a couple times when there's been mass exoduses for like the Central Valley and things that have lasted for a couple years and then not. And there was one time, it might have been in the 80s, where lenders actually started refusing to do what they call commuter loans. I think it was anytime you had a commute of over 35 miles, they essentially weren't willing to do your loan because they were seeing a huge foreclosure rate in the commuter loan properties, people that had long commutes. Here's the sold prices. Let's see if these look reasonable. These numbers look reasonable. I don't know why they wouldn't have transferred. Central Valley, Central San Jose is at 1,800,000 to 700. So these numbers here, I would have confidence in. I have no idea where those other numbers came from. I'll have to find that out. I have been working with my automation, trying to cut down the amount of time it takes every week. So I goofed something up. But this data on this slide does look accurate. I see nothing that jumps out as a red flag saying that there's a problem with it. So I would trust this number, so I wouldn't trust the others. And what's interesting is I don't even think the numbers were the same. Actually, they might have been. I'll go back and look because the 5.1 I thought it was 18, but I think it was 2.6 and 55 million. So for some reason, the Atherton numbers were showing up as East Central San Jose. And then here's the percentage of offers versus typical. You can see across the board, we have a lack of offers. The peninsula is actually coming back in part because they were reduced number of offers that were after the pandemic, which pulled down the 10 years. So with fewer number of transactions, they're closer to their 10-year normal. In fact, they are 99%. You can't get more than normal than that. But 73% in Alameda County, 73% in Santa Clara County. This is the percentage of active listings. So you can see you have less active listings in Campbell and in Saratoga, Los Gatos, as well as the expensive areas and Redwood City. Most areas have a slight surplus of inventory. Santa Clara County overall, though, has a shortage of 15%. The other two counties are both slightly positive. Here's a summary. We went over this at the beginning, so we won't spend any time on it. It's just for a recap. This has been the Silicon Valley real estate market. We will continue with Silicon Valley real estate market. We have the distributions and a few other county comparisons coming up. Then at the last 7 minutes of the videotape, I spend on the Greater Bay Area, 13 counties. The handout is up. It was posted about 5 minutes before the hour. You type in the green root URL H for handout 2025. 12 for December, 06 for today's date. And this is now 2 weeks old because I was running out of time. The PowerPoint presentation or the Zoom meeting, you can join by either typing in the green root URL in 2025 or the blue URL. The archive on YouTube is on here, either the blue YouTube direct link or the green root URL by itself. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers here in Silicon Valley. Would appreciate likes and subscriptions. Let's continue with the presentation. This is a quick summary of things that I can do for people that want to work with me. I can give you details to the listings. I can give you map links to Google Maps. I can give you school names or ratings, and I can give you commute times to different locations at the time of choice for you. Here again is some more definitions for you for more details. Here now is the distribution for the time to sell. I've added a few more bold lines on here to try to make it a little clearer on the points I'm trying to make. The blue line up here is the coldest marketplace we've ever had, the slowest marketplace. The red is the hottest we've ever had. Now what I've added in, the purple is the current week. The dotted line that's right by the purple is where the data was a year ago. That's where we're going to start off. But before we start, I wanted to highlight the green line up here. That's the hottest we've had in the last 53 weeks. And the gold line down here is the coldest we've had in the last 53 weeks. And you can come up and then see it. So here's the green line. The coolest was December 12th, 2024. So exactly a year ago. And then the hottest marketplace we had was the week after Valentine's Day, February 21st, 2025. And so the concept is you're starting on the dotted line a year ago. In which direction does the market go? It's going to slow down. Then it's going to rapidly accelerate, then it's going to slow down, and then it's going to do a whole lot of bouncing. So let's step through and see it actually perform. So there it's slowing down. There's the peak. They're the slowest. And then it spends a couple weeks to near the top, and then it rapidly improves as we get into the new year. There's the bottom right there that we talked about. Now it's accelerating. And you can see it's just slowing down. I'm sorry, now it's slowing down a little bit every week. And now it's going to get in and it's just going to bounce around. See how, and now it's going to slightly improve. There's the bottom of the improvement, the hottest of the improvement. Now you're slowing back down. And finally, the current week. So from here, it's going to slow down to the end of the year, probably just like it did last year, and then it's going to accelerate rapidly. Now, my prediction is the acceleration may happen a little late or not be as rapid because of the Super Bowl being local and the potential of the 49ers being in it. Now, the exact same thing with the largest price reductions. You can see the purple line, and now the dotted line from last year is zigzagging on both sides of it. So you're basically taking the same reductions as we did last year, the coolest marketplace. And here I have the best and the worst, and they're probably the same. So the worst is December 27th, 2022. So right as we had that price correction coming out of the huge boom in 2021. And then the hottest marketplace that we had, the best ever up here, the red line, in which there was basically no price reductions whatsoever, was Valentine's Day of 2022, which was just before the price dropped. And in fact, that's about the day that I think the market really turned. Most people think it was a little bit later in the year, but I think when you really look at the data, it was essentially Valentine's Day. And then you have the peak here, which is Valentine's Day of 2025. Real estate's very holiday cycle centric, because it's an optional event. And then the lowest year, you got a couple lowest on here, and I'm not even sure which is which because they're both green, unfortunately. I think the one up here that's a little bit higher here and then a little bit lower is November 22nd, 2025. And this steeper one, the one that's close to the purple line, is the more recent one on August the 30th. So you can see they were pretty close. And what you'll see as we step through, those were turning points. So now we're starting off a year ago. And now here you are, you're rapidly accelerating. So less and less price reductions. That's essentially the fewest price reductions. Now you're already in more price reductions. The market's cooling already. You can see it's cooling rapidly. It's still superheated, but it's cooling. And now you're basically in the bounce range. And now what we're looking for is a green one coming up right there. So that's sort of the coolest. Now you can see that it's heating up. And that coolest was August 30th. Now you're back to where you were around August 30th. Now you're even lower last week, and this week was a slight improvement. So last week was a little bit more price reductions than this week. Coming out of Thanksgiving, people are inclined to do price reductions. Now that we're a full week past Thanksgiving, the price reductions already occurred. Nobody's doing price reductions going into a holiday, just like they're not listing properties going into a holiday. This is overbidding, so it's the exact same concept. Here, I have it a little clearer for whatever reason, maybe just the way the data lined up. Here you can see the peak of the marketplace. The hottest marketplace was April 5th. But if you think about it for a minute, you need to wait 5 weeks for escrows to close. So when were those peak offers negotiated? Basically, you go back 5 weeks, 35 days. So 5 days is March 1st, 30 days and 31 days in March. So call it March 1st. You're at the end of February. So again, very close to that Valentine's Day timeframe on when the buyers were feeling the most overbidding. And then the coolest marketplace is down here, and that's August 23rd. So we slowed down in August, which a lot of people don't understand and have a hard time believing. August is typically a slower month, and then we heat it up again before we're starting to cool off. So let's step through. You can see the overbidding really not going anywhere, and it's lagging, so there's more data points. But now that we've ate up to 5 weeks, it's going to cool off pretty rapidly, and it's already heating up. There's the peak of the marketplace right around there, and it's up there for a couple of times. There's March 22nd, which is a fairly high market benchmark. I think I pegged it at April the 5th. Now you're cooling off. There's sort of the bottom of the market, the 26th of July, and then I actually had it pegged on the 23rd of August, which I think is more accurate. And now it's heating up again, and we're still basically heating up. Now we're going to cool off starting about this week coming forward. Yep. So there was a little bit of cooling off already. Here's more detailed information for those that need it. Here, again, now what we're doing is we're looking at the turnover rate. So this is the turnover rate for Silicon Valley, all 3 counties. You can see that we're between the blue line and the gray line. We're actually following this little bump perfectly. You had a slowdown because you had a lot of inventory come on the market this week, and you haven't had time to sell it. So next week, the most likely line is going to go down because this weekend, we're going to have time to sell the new listings, and the number of offers are going to increase. Here's on a percentage basis, so you can see that we're slowing down a little bit, but again, next week I expect that to increase. Here is the typical time, the marketing time. Look at that increase. That's actually fairly significant. So marketing time is going up, at a time it went up significantly at a time when it really didn't. You would almost expect it to go down. Now, I will point out again that Thanksgiving was essentially as late as it could be this year. So if marketing time improves this week as a result of the sales that happened for the new listings that came on since Thanksgiving, that number will probably come down. It's a question of how much it will come down. And also the gray line number is much smaller because that's a 10-year median, and it's Thanksgiving moves between 2 weeks. It moves 7 days, and it's in 2 different weeks of my real estate year. So this is the time for the sellers to sell, the typical marketing time. Here's on a percentage basis. Again, you can see the huge increase. I expect a decrease next week, but only time tells. Here's the price reduction. I like this metric. We're going to do the average next, but the reason I like this is it shows you what the extremes are doing. But we are taking more price reductions than we normally do, but still fairly reasonable. And it also gives you an idea of the sellers that are taking price reductions. They're taking a 14% price reduction on a $2 million house. That's $250,000. It's $280,000. So it's not the sellers that are doing price reductions, they're not insignificant price reductions. This is the average, so that 14% correlates to about 1.5% on average because so many people don't do any price reductions whatsoever. But again, it's between the typical marketplace where you'd expect it to be and a cool marketplace down there at 2.5%. Here's the percentage of normal. So you can see we're taking slightly more price reductions than we normally do, but it's pretty close to normal, way closer to normal than we were earlier this year, where the price reductions were pretty significant. In fact, I'm a little surprised they were that high. The market was still fairly good, but in 2024, the price reductions were fairly reasonable all year long. Here's the frequency of price reductions. So you come over here and it's only 22% of the sellers are doing price reductions. Normally it's 20%. So you have 2% more, which is 10% more sellers doing price reductions. It does get all the way up here to 35%. Here's the frequency compared to normal. So I had it at 10%, and that's pretty close according to this graph as well, because this is 20%. That's going to be 10 right there. It's a little bit more than 10%. This is overbidding magnitude right at normal. Look how rapidly it improved, and then it just followed the normal trend. And that's what happens in real estate. It changes on a dime. Check the bend there, check the bend up here. This is the 2022 price crash. And this is overbidding. So this is delayed by 5 weeks from when the market changed, and that's still in first quarter. It clearly happened sometime in first quarter because it happened 5 weeks before this amount of overbidding. The buyers started to feel less and less overbidding pressure. Here's on a percentage basis. You can see we're almost normal. We're about 0.5% more overbid. That's in raw count. I didn't do a percent on a percent. It's 0.5%. And I think the numbers were 4.3 to might have been 4.9. So it might be 0.6% overbid. Here's the frequency. So right now, just under 60%, looks like about 58% of the sellers are getting overbids in Silicon Valley. Here's the frequency on a percentage of normal. So you can see the percentage is improving, more and more sellers getting overbid and getting closer to normal. Here's your pricing model. You can see that I have it at 12.1% for 7.25 years, and then flat basically for the last almost 4 years now. And yes, there is an annual cycle on pricing, but overall the growth has been flat. Here's the offers accepted. You can see that we're rapidly approaching the blue line, but they fall down so rapidly. This is the annual cycle. That's why I do these annual cycles, is look how much that data fluctuates from year to year. You can't sit there and expect it to be at a flat level. Here's the active inventory. Again, the huge annual cycle. You can see we had a surplus of inventory earlier this year. Starting in third quarter, we were basically normal, and we continue to be normal in fourth quarter. Here's more definitions for those that need it. This is the turnover time for the 3 different counties. So this is the market, not the turnover time, the rate of time to sell the marketplace. Alameda County is the slowest. Santa Clara County and San Mateo County are essentially tied. This is the typical time for sell. Santa Clara County is the fastest. It looks like 33 days. 35 days, and 39 days for Alameda County. Price reductions on average, San Mateo County is doing the largest price reductions at almost 2%, about 1.7%. Alameda County is second at about 1.6%, and Santa Clara County is doing the least amount of price reductions at 1.4%. This is the frequency of price reductions, fairly close together. It looks like Alameda County and Santa Clara County are close at 21%, and San Mateo County is higher at 24% of the sellers are doing a price reduction. This is the average overbid. Santa Clara County at 3.5%, San Mateo County at 5%, and Alameda County at almost 7% overbidding. So Alameda County, with the slowest marketing time, is having the most overbidding. Sellers could be reducing their price and enticing the buyers to come in and overbid. Here's the frequency of overbidding, very close together, plus or minus 2% of 60, 58% in Santa Clara, the lowest 60% in Alameda County, and the highest is San Mateo County at 62%. Here's the long-term appreciation. Santa Clara County is doing the best with almost 100% appreciation. Alameda and San Mateo County are very close together, about 62% appreciation. Here's the median sold price. You can see the prices have been basically flat in all three counties. Here's the same information on regular paper. The previous was log paper. And here's your payment using high balance conforming loan limits. That was offers. That's offers going down in all three counties. Active inventory going down in all three counties. And here's your number of offers accepted. You can see, again, we're the 8th slowest year out of the last 10, but more significantly, the 22nd slowest year out of the last 25. Here's the raw numbers for those that want. Now we'll move on to the Greater Bay Area, covering 13 counties and 5 regions. These are the 5 regions and the 13 counties that are in those 5 regions, plus some more details for those that are following on their own. Moving on to the turnover time. This is how long it takes to turn over the market one time. You can see that we increased the week after Thanksgiving because now you have more inventory and you haven't had time to sell it. I expect that numbers to be going down next week. This is the time to sell for the typical seller. The 3/4 of the sellers sell in this time or less. Fastest area is Silicon Valley at 40 days. That means 3 out of 4 sellers are selling in less than 40 days. Only 25% of the sellers are taking longer than 40 days. That may sound fast, but if you start looking back over time, that's reasonable for where we have been over the past 10 years. There's obviously some years like 2021 and 2020 where the time to sell was quite a bit lower, but then there's also peaks typically right after the first of the year where we're higher. You're typically climbing between now and the end of the year. So it will be interesting to see where we are at the mid-January timeframe of 2026. It will be higher than it is now, but the question is how much higher. Here's the seller's average ask price reduction. So you can see Central Coast is taking the largest price reductions at about 3.5%. North Bay is next at about 2.75%. Then the cities, San Francisco and Marin, at about 2.4%. Central Valley at about 2.1%. And the least price reductions is Silicon Valley at about 1.5% of price reduction. That's on average for all 5 regions. You can see that there's been times when they've been greater, but they're bigger than when they typically are. You know, the larger the price reductions, the more the sellers were expecting a higher price. The reason the number is so small is simply because so many sellers do their homework and price their home correctly. 75% are selling in under 40 days. 50% of the complete total, so not 50% of 75, but 50% of 100. So 50% of the sellers are selling in about 1 week. Then you have 25% that are selling in the next 30 days, and then you have 25% that are taking longer than that. This is the frequency of price reductions. So how common? You can see Silicon Valley has the least number of price reductions at 22%. San Francisco and Marin is next at 26% of the sellers reducing their price. That's only 1 in 4. Then you come up to almost a 3-way tie. Central Coast is actually the next at 37%, and definitely a very, very close 2-way tie for last place, with being Central Valley and North Bay at 40% of the sellers. So 2 out of 5 sellers are doing a price reduction in those 2 regions. Overbid, how much are the buyers coming in? The highest overbidding is in the cities. 9.25% over the seller's ask price. So if you're asking $1 million, they're going in at $1,095,000. Silicon Valley is next at about 5% overbid. So if you're got $1 million house, it would be $1,050,000. Then you come down and you have three regions below 100%. You have the North Bay at about 0.25% below ask price, Central Valley at about 0.5% below the ask price, and the Central Coast at a full 2% below the seller's ask price. So buyers are coming in below the seller's ask price in 3 out of the 5 counties. Moving on to the frequency of overbidding. How common is overbidding? In San Francisco, and Marin, you have 2/3 of the sellers getting more than their ask price. Silicon Valley is just about 58%, a little bit higher. North Bay is next at about 34%. More than 1 in 3 sellers are getting more than their asking price. Central Valley is just under 31 in 3 at 32%. And the least amount of overbidding is the Central Coast at about 22% of the sellers getting more than their asking price. So more than 1 out of 5 sellers are getting more than their overbid. So, overbidding is still fairly widespread. Here's long-term appreciation. The cities in Marin have been doing the least well. You can see that they're about 42% appreciation since 2015. Then you have a two-way tie between the Central Coast and the North Bay at somewhere around 67%, 68% appreciation. Then you have Silicon Valley next at about 82% appreciation, and the area with the highest appreciation is the Central Valley at 84% appreciation. Getting close to doubling your money in both Silicon Valley and the Central Coast, or Central Valley, not quite doubling, but getting close. 100% appreciation would be doubling. You have to subtract 100 off the index over here. Then you look at the median sold price. The area that has the highest price is the cities at about 1.68 maybe, so just shy of 1.7 million. Then you have Silicon Valley at about 1.575, just shy of 1.6. Central Coast at just over 1,050,000, or right about 1,050,000. North Bay somewhere right around, well, almost exactly at $800,000. And the most affordable area is the Central Valley at about 530,000. Here's the estimated payments using the current interest rates, which are coming down a little bit. Currently, for high balance conforming, for the national average is 6.19%, I believe the number was. And then I assume an 80% loan, do an estimate for property tax and insurance. Here's the number of offers accepted. You can see the offers accepted are going down in all areas, going down the most steeply in Silicon Valley, but North Bay and Central Valley are coming down fairly significantly. The cities and the Central Coast have been coming down longer, but at a much slower rate. Here's the active inventory. Active inventory is coming down in all 5 regions. It's hard to say which one's the steepest. Clearly coming down in the North Bay, clearly coming down in the Central Valley, clearly coming down in Silicon Valley, a little bit less, well, clearly coming down in the cities in San Francisco and Marin, but it's a lower number, a little bit more gradual in the Central Coast area. Here are the raw numbers. The now column is the current data for Saturday, December the 6th. The 1 week ago is the percent change from a week ago and percent change from 5 weeks ago. So the turnover time is actually higher, which is a slower marketplace from a week ago, but faster than it was from 5 weeks ago. So that's how you read this table. You have the counties coming down the side as well as the regions that are bolded. And I've added in the Bay Area includes the 9 counties that touch the Bay. It includes everything except for Central Valley and Central Coast. It would be the first 3 regions and 9 counties. That's what the media talks about quite a bit. With that, we've been talking about the Silicon Valley real estate market, then we just finished up with the Greater Bay Area. If you want the handout, which got posted about 10 minutes before the hour on Saturday, it's a tiny root URL, which I call the green root URL. Then add in the letter H for handout 2025. Month is 12, and the day is 06. This is last week's link. I didn't have time to update the slide for this week's. The live presentation, join that by typing in the green root URL and then 2025 Saturday morning at 9 o'clock, or type in the blue longer Zoom link, because I do hold these on Zoom. And then the archive is the green root URL by itself, takes you to the same blue link for YouTube direct link to the channel. I'm Richard Calhoun, real estate broker with Creekside Realty. Contact information representing either buyers or sellers in transactions here in Silicon Valley. Appreciate likes and subscriptions. Take care. See you next week. Bye for now.